All right, so in this video, we're going to go over moving averages. And averages is something really important because it can help you identify a trend a little bit easier than using market structure. And it gives you a nice visual to how deep a trend is or how strong a trend is with moving averages when you tend to use a couple of moving averages or more than two or three because you'll be able to really see, how strong a trend is. I'm going to explain that, but let's start with just the moving average in itself. Moving average is a line that is created from the closing price of the chart. So basically, the closing prices. So if I was to kind of illustrate this, say price, you have the line chart, right? With stocks, a lot of people are familiar with line charts. Well, moving average is, say if price was like this and it closed here, closed there, and it's just recording the closing prices of a certain time frame. A moving average is basically going to take the certain number. Let's just use 20, a 20 period moving average. What that would mean is it takes the last 20 closes of price and it creates a line from the average of it. And every line, part of that line is going to be the new average of the 20 prices that the moving average is calculating. So let's just say that you have 20 data points. The moving average is going to take the average between those 20 data points. When the 21st data point arrives, the next closing price, let's just say days or the data points to make it easier. The next closing price, what the moving average is then going to use, if it's a 20 period moving average, it's going to use day 2 all the way up to day 21 to make 20. And basically, the price, the average of those 20 prices, is going to be where that line is. And it's going to continue to do that. Let's say the 22nd data point, the 22nd day's prices arrived that it closed that day. No, the moving average for a 20 period moving average is going to use between the third day and the 22nd day to make 20 and create a new line, a new average in there. And then it's just going to connect the dots between those average prices and make a line. So let me go and show you a live example of that. So to actually access a moving average, you're going to go to indicators on TradingView. And what I like to do is just type in moving average. So there's two major ones, there's three, but most people just use one of these two. And you have the simple moving average or just moving average on TradingView and the exponential moving average. A simple moving average is going to do the exact explanation to what I just said a moving average was, where it's taking the last certain number of points, the last 20 number of periods, the last 20 periods, and making an average price, and then continuing to make an average price and create a line from that average. An exponential moving average is going to put more emphasis on more recent price action. So say if it's a 20 period moving average, it's going to weight maybe the last 10 or the last 8 price closes a little bit more than the older price closes to give you a more reactive line. So what I'm going to do to illustrate that is I'm going to put both moving averages on here. And I'm going to make the simple moving average yellow and make it big. I'm going to make the exponential moving average red and make it big. And then what I'm going to do is I'm going to make it a 50 period moving average. So basically, the moving average is going to take the last 50 closing prices and make an average of them. And then on the exponential moving average, it's still going to take the last 50 moving averages, but it's going to give more emphasis to the newer price data. So the more recent price data. And you notice that the moving average, the simple moving average, moves slower. So like right here, the simple, price goes up here, makes a sharp move. It takes a while for the simple moving average to start to move up to reflect this. But on the exponential moving average, it follows closer behind price, the more recent areas of price. So because of this move, the exponential moving average moved up faster. And then you see the shift here. It takes longer for the simple moving average to start to curve down fast. But you see that the exponential moving average just curves down faster to measure out this move here. So that's the difference between the simple moving average and the exponential moving average. So how do you use this for trend? So let me, pick one of the moving averages just to make it simple. I'm going to add maybe one more moving average. And we're going to use the 20 period, for example. I'm going to make it green and then make it 20 period. So how do you identify when trend is changing or what trend is with the moving average? There's two ways to do it. One is if price is trading above. So if price is trading above the moving average line, it's a uptrend. Price is in the uptrend. If price is below the moving average, it's a downtrend. And then for consolidation, if price is indecisively, that's the best word to use, or being really choppy in between, there you go. If price is in between two moving averages, or is switching up and down, being indecisive, above and below price, it's in consolidation. And you shouldn't really take a moving average. Like when it's in consolidation, like don't really pay attention to moving averages. Moving averages, a rule about that is best when the market is trending either up or down. So basically, this would be kind of the rules for an uptrend. This is one of them. If you're using two or more moving averages, then what you can use is a fourth rule. If the faster or the faster moving average, the one that's going to have the least numbers. So in this case, the faster moving average is the 20 moving average. The faster moving average is above the slower one. Price is in an uptrend. And then if the faster is below the slower moving average, price is in a downtrend. So that's when you're using more than one moving average at a time. That's another rule that you can use. Using more than one. Went blank for a second. Using more than one moving average. There we go. Typing and talking is not as easy as it looks, and that's for sure. So here's a couple examples. So if we use the first rule, if price is moving above the moving average line, price is in an uptrend. So we see here that price is trading above moving averages. So that's an uptrend. If price is trading below the moving averages, like right here, it's in a downtrend. So that's one way you can do it. The other way would be if the moving average, if you're using more than one, if the faster moving average is above, the slower one is in an uptrend. So right here in this area, from there to there, the faster moving average, which is the 20 period green line moving average, is above the slower 50 period yellow line moving average. Price is in an uptrend. And then from here to there, the green line is below the yellow line. So the faster moving average is below the slower moving average. Price is in a downtrend. And then if we use the consolidation rule, if we look here, price is all in between, and the moving averages are all in between with no movement. That's what a consolidation looks like. You see how the price is just equal highs, equal lows, and then you have the moving averages just crossing all between each other, and price is just chopping between the moving averages up and down with no direction. That's consolidation. So that's how you can use moving averages to make it easier versus maybe looking at market structure, even though market structure is very important too. But I hope this video helps. Definitely watch it over and over again until you understand it. But that's how you use moving averages to determine trend.